Okay, I'd like to get started, and I want to say welcome, everyone. This is our Wolters Kluwer What Are the Experts Saying webinar series. Today we are talking about the 114th Congress, and specifically what financial reform legislation is likely to pass in the 114th. So thanks for being with us. Glad you're here. Today we have three moderators, myself, Jenna Ellis, and my two co-moderators are Dan Titello and John Cullagure. So thank you, John and Dan, again, for assisting me with the moderation.
Sure.
Today, if you have any questions, or you have a question maybe for Jim, or if you're having any problems, you can use the chat feature just by pulling down the top panel and clicking chat and then dropping down to John's name, and I have it circled right here. So if you drop down to John, you can just privately chat with him. So any issues or questions, please go ahead and do that. And so with that, I would like to welcome Jim Hamilton. Jim is our expert today for this webinar. And I'm sure many of you are real familiar with Jim, but Jim is a principal analyst and prolific blogger for Jim Hamilton's World of Securities Regulation. He's been tracking, analyzing, and explaining securities laws and regs for nearly 30 years and co-authored the Dodd-Frank Law Explanation and Analysis. Jim was also cited twice as an authority in the Senate Banking Committee report accompanying the Dodd-Frank Act. So welcome, Jim.
Thank you, Jenna.
So Jim, following these latest elections, there'll be a change to the leadership in the 114th. Specifically, I guess, the Republicans. So today, I wanted to start by talking about the differences in philosophy, even within the leadership in the House and the Senate, and also then talk about four key areas related to financial reform where we're likely to see just a lot happening. But before we kind of dive into that, for an example, Jim has put together a list of bills that have already passed in the House, and these are likely to pass in the 114th. And this is actually something that we'll send to all of you attendees. And then, Jim, would you like to say anything about the bills before we begin? And we'll be sending that out again. But would you like to say anything?
Thank you. I would. These bills are bipartisan bills to a greater or lesser degree. Some overwhelmingly bipartisan, some not so overwhelmingly. That passed in the House. There's about 23 of them, and were not taken up by the Senate during the 113th Congress. I want to amend that a little bit because, to give you an update of what's happening today in Congress, two of the bills in my chart, in my list, are being considered as we speak to some extent. Now, the Business Risk Mitigation and Price Stabilization Act, H.R. 634, was included as part of Title III to the Terrorism Anti-Risk Act, the TRIA Act, Anti-Risk Insurance Act. The TRIA Act passed the House yesterday and has gone to the Senate because of this Title III. So the Senate would have to agree to that. I believe that they will. I'm not sure when. It may happen today. So we would have one of these bills would then go to the President's desk. That would be H.R. 634 as added as Title III. This is a very bipartisan bill. It passed the House 411 to 12 last year, and would basically exempt non-financial companies that use derivatives to hedge risk, like airlines that use derivatives to hedge the price of fuel. It would exempt them from the margin and capital requirements of Dodd-Frank. So that is probably going to pass on the 113th, so I want to amend that one. The President issued a statement of policy, which some people opposing including that fix in the TRIA Act, but he stopped short of a veto message, so it's pretty presumed that he would sign it. The other one is the Swaps Regulatory Improvement Act, H.R. 992. This is a little more controversial. It passed the House 292 to 122. 70 Democrats voted for the bill. It would basically change very dramatically the bank push-out provision, Section 716 of Dodd-Frank, which requires banks to get rid of their derivatives trading desks, push them out to another entity. This would roll that back and allow them to keep a lot of the trading activities inside the bank. So you can imagine that is more controversial than the end user provision, end user fix. But this is now part of the spending bill, H.R. 83, which the House is debating at this very moment and expects it to pass today. So it goes to the Senate, and I think there's been a mini revolt against including the swaps push-out provision in the spending bill, and so we'll have to see if that will hurt the bill or kill the bill. But I just saw a few minutes ago the President issued a statement of policy on H.R. 83 saying that he regrets or is upset that the bank's push-out provision was included in the bill, and it possibly could hurt the markets. Is opposed to the inclusion of the rider that would amend Dodd-Frank and weaken a critical component of the financial system reform aimed at reducing taxpayer risk, is the actual language used today by the White House. But again, stop short of veto message, and apparently, this is my conclusion, that the President will sign the bill if the Senate can pass it. If the House passes it today, and the Senate passes it, I think the President would sign it with the Dodd-Frank corrections. So we have two opportunities to get two Dodd-Frank corrections before the 113th adjourns. Sign or die.
Excellent, great, thank you. That's really great info, really great up to date info. Actually up to the minute, as you were saying, and everyone also, again, we will send this out to you after our webinar has concluded. So, okay, Jim, let's jump back into the discussion. I first want to address leadership in the 114th, and now, especially, let's start in the Senate, and now they're taking over again as leadership in the 114th. So, can you start there, and I guess really with Mitch McConnell's return to order?
Well, thank you. Yes, Mitch McConnell has said that the Senate will return to regular order, which means Congress will return to regular order. What regular order means is that the committees, the oversight committees, for us, the Senate Banking Committee and the House Financial Services Committee, which oversee the securities and banking agencies and industry, will report bills. They will have bills in the committee. They will mark them up. They will report them out to the floor of the House or Senate, and which would be passed. Then they would go to a conference committee, House Senate Conference Committee, iron out the differences, and get a conference bill and pass it. This is the regular way legislation has been created for many, many decades. It broke down in the last 4 years where we didn't have that happening. So I think I've researched this correctly, the last House Senate conference was with the Dodd-Frank Act in 2010. So this is an important return. If it happens, it would mean that it would be better to get legislation that way.
And then, Jim, this is Dan. So that's in the Senate. Who are the other players in the Senate? Richard Shelby, I think, is on our next class.
Everyone expects, and it hasn't been denied, that Senator Richard Shelby of Alabama will be the new chair of the Banking Committee. He is the new old chair. He was the chair from 2003 to 2007. So he is taking over again the Banking Committee. Again, everyone expects, it hasn't been officially announced, that Senator Sherrod Brown of Ohio will be the ranking member. And I think it's important to, just for a second, to note that in the Senate, it's very important who the ranking member is of the committee, because right now every bill that's coming out of the Senate Banking Committee and going to the floor, if it will have any chance of passing, will have to be bipartisan, because 54 members of the Senate are Republicans, which is far from 60, and you still need 60 votes in the Senate to pass any legislation dealing with financial services, securities, or banking, and they will have to get 6 Democrats to agree. And it's going to be important that you create a bipartisan bill in the Banking Committee. So Senator Shelby has done that when he was chairman in 2003, 2007. So, so anyway, that's the Senate. In the House, of course, it's different because they have, you don't have the ability to filibuster a bill in the House. So,
who are the players now in the House?
Well, in the House, we have returning to the chairmanship of the Financial Services Committee, Jeb Henschling of Texas, who has been very active, and we see his activity this very day in inserting the derivatives end user fix, and he passed all of these bills. Most of these bills came out of the Financial Services Committee through, and got him to the floor. And so he's a very active legislator and is very committed to Dodd-Frank corrections.
Okay. So when we talk about Shelby and Henschling, did you want to compare kind of and contrast their philosophies? That's interesting, I think.
I think it's important. Yeah, the difference in philosophies may come into play. Representative Henschling is a traditional conservative, whereas Shelby has populist tendencies. Don't forget, Senator Shelby started out as a Democrat, switched parties a number of years ago. He is not someone you can say would back totally every single thing that the traditional conservative would want. So I think that could come into focus. And,
so,
yeah.
Sorry, go ahead. I think also, when we talk about their differences and maybe start talking also about the mortgage securitization reform and one of the first things as it relates to their, comparing and contrasting their philosophies.
Well, that's a good point, Janet. One of the things that has to get done is securitization reform to jumpstart the private securitization market, particularly in mortgage-backed securities. Dodd-Frank did not address that and intentionally did not address that. It was deferred, and they said we'll get to it later. It's 4 years later. They haven't gotten to it. There were two bills in the 114th Congress. One, and this brings out some of these differences, that Chairman Henschling had a bill, the Financial Services Committee, the Protecting American Taxpayers and Homeowners Act, the PATH Act, which H.R. 2767, that would have ended Fannie and Freddie, jump-started securitization privately, and pretty much ended the federal government's role in that. The Senate bill was very different. It was a bipartisan bill, the Housing Financial Reform and Taxpayer Protection Act, Senate 1217. It was a bill that was created by the current chairman for the next few days anyway, Tim Johnson of South Dakota, and the ranking member, Mike Crapo of Idaho. The Johnson-Crapo bill is called, and it didn't end federal involvement. It kind of very gradually weaned the markets off federal involvement to create a private securitization market, and creating the Federal Mortgage Insurance Corporation, a new federal agency to develop standard risk-sharing mechanisms and products that require private market holders to assume a first loss position. It kept Fannie and Freddie going for quite a while, perhaps. So we can't get into the details of it, but interestingly, Senator Shelby voted against the bill in the committee, presumably because maybe there's a new federal agency. But this brings into stark relief. But Senator Shelby most people presume, would not support the Henschling bill because he doesn't want to end completely government federal involvement with securitization, and he wants a more gradual approach. Senator Shelby has consistently argued for meaningful financial reform in the area of secondary mortgage securitization. When he was chairman of the Banking Committee, he held multiple hearings on reforming the mortgage-backed securities market, which culminated in the committee reporting out the Federal Housing Enterprise Regulatory Reform Act, 2005, Senate 190. You can take a look at it. It was never enacted, but it could be a blueprint for what he might want to do next year. Senator Brown had said recently that the Johnson, by the way, he also voted against the bill. The Johnson-Crapo bill is a non-starter in the 114th Congress. They're not going to use it as a benchmark and begin with it. They are going to scrap it basically and start fresh. So that's kind of where we stand with mortgage securitization.
And Jim, can I ask? This is Dan. I was going to ask a question. Are they? Did both Brown and Shelby have the same perspective on the FMIC? Is there? Do you think?
Well, no. Actually, the Brown opposition came from not enough involvement with communities and community outreach in the bill, and to help poor community, to help disadvantaged communities have more access to lending and mortgages. So they came at it from very different perspectives, but they got there. They got the same place, but yeah.
Okay. Jenna?
Hi. Yes. So I also wanted to move, I guess, to Dodd-Frank. And, Jim, is it correct that you believe that most people have, come to a conclusion that we have this Title II of the Dodd-Frank Act, but we haven't really reformed too big to fail, and that it still exists?
I think that a lot of people, and I'm one of those people, have gone to the conclusion that Dodd-Frank did not solve too big to fail, that we still have it. And I think that Richard Shelby believes that more to the point. So I wanted to, it's an interesting confluence of events I just want to mention very quickly that during the Senate deliberations of Dodd-Frank, Senator Brown had an amendment which would have broken up the big banks, kind of spin off into more manageable sizes. That was an enormous amendment to Dodd-Frank, and it was defeated 61-33 in the Senate and never became part of Dodd-Frank. Actually, Dodd himself voted against it. So did the current chair of the Bank Committee, Senator Johnson. But interestingly, Richard Shelby was one of only 3 Republicans to vote for the amendment, excuse me. So I think that's very interesting, and that shows kind of the populist strain in Senator Shelby. So now we have a chairman and a ranking member who both supported breaking up largest banks. It's on the record. I'm not sure if there's 60 votes to ever do that, but there might be more than 33 right now. The legislative effort involved to it, and one of the things that we mentioned was the Financial Institutions Bankruptcy Act, which passed the House and provides a bankruptcy alternative to Title II for a failing financial institution. We found out the bankruptcy code couldn't deal with winding down hundreds of thousands of complex derivatives contracts like what happened with Lehman Brothers, and so Title II is a good, viable title. I'm not saying it's a solid, good title, well thought out. It's I haven't really read it, but it's extremely detailed. But the question is, would any of these institutions be put into it? So you have the bankruptcy alternative, which Dodd-Frank itself says you should try that first anyway. So I expect that bill, which passed the House recently, there's no time for the Senate to take it up, but I think it's going to come back up again next year. And I believe myself that Senator Shelby will be part of the Senate movement to try to do something like that. Certainly Spencer Baucus earlier, the chairman emeritus of the Financial Services Committee, was the one who sponsored this. He's also from Alabama, and the Financial Institutions Bankruptcy Act. And I think people are starting to say, wait a minute, let's get the bankruptcy alternative out there.
And Jim, there was a couple of points that Shelby had made about what he thought would be required as far as like changing market expectations and realistic tools.
Senator Shelby said, Senator Shelby wants to deal with that. He wants to deal with too big to fail. He has said that however Congress chooses to end too big to fail and to mitigate systemic risk, none of its efforts will succeed unless Congress changes market expectations regarding bailouts, requires enhanced private sector due diligence, and provides regulators with realistic tools to achieve them. And I want to focus on realistic tools for a minute. That's what this Financial Institutions Bankruptcy Act does, provide the bankruptcy, put into the bankruptcy code tools by which bankruptcy courts can deal with these extremely complex structured derivatives contracts and winding those down, and you're going to keep the institution serving people in the way that they do, while you wind down, I believe I read that Lehman Brothers had 800,000 derivatives contracts. It's kind of mind-boggling when you think about it, and I think that winding those down has been very difficult. So tools is what Richard Shelby's talking about. Give them the tools to do it. Thank you.
Okay. So, when I have a question then about these Dodd-Frank, the corrections, I guess. Are they, are they just more corrections, or are they going to be fundamentally changing Dodd-Frank?
They will not fundamentally change Dodd-Frank, because I don't believe they could get 6 Democratic senators to agree to that, and certainly the president would not sign legislation that fundamentally changed Dodd-Frank. That said, you can have many corrections to Dodd-Frank, and we list them in these bills, a lot of them, and there are others that I cut off this chart with bills that passed the House. There was a number of other bills that were reported out of the Financial Services Committee, which are very bipartisan. They didn't get to the floor for a vote this time, but one would be, just an example, the Inter-Affiliate Swaps Clarification Act, H.R. 677, which would exempt inter-affiliates, in other words, subsidiaries of a large holding company doing derivative trading among themselves, would be exempted from Dodd-Frank's margin clearing and reporting requirements. In other words, the thinking being, if it's within the company's, it's in the company, why should that bother anyone else? So that was reported out of Financial Services Committee 50-10 by the Ag Committee by voice vote. The Ag Committee had concurrent jurisdiction of that bill. And that didn't make it to the floor. I'm not sure why, but that would be one that I would expect to see as a Dodd-Frank corrections. We mentioned the 2 that are possibly moving this week to be enacted. So yeah, I think there's many corrections. You can look at the chart later and see many of them that could be done bipartisanly.
And Jim, that was going to lead to one of the questions I had was this list that we're showing on the screen now is an example of the list that we're going to send to everybody who's listening now. But is it fair to say that that we can look at that list after we send it out, that people could see that as possibly a roadmap to what the Republicans will kind of want to start with, especially considering 2 of them were already kind of being inserted in the lame duck? Or how people look at that list?
Dan, yes, I think this is a roadmap to the 114th Congress, I think. All of these bills will come up again. Some may be bundled together and not be separate, but all of them are coming back, almost all of them. So yes, this is a roadmap, I think, to, now that we have a Republican Senate, they're going to probably pass the Senate also. The question always comes down to what will the president sign, to my mind. And, I think if they work with bipartisanly, they can get some stuff done.
And I think that's a kind of a good segue to the regulatory process, I guess the regulatory process itself. And back kind of with Shelby, I believe he'd have, would like to have to create kind of a council of economists. And so, do you see that being part of upcoming regulatory reform?
I absolutely do. The reform of the federal regulatory process has become front and center. The Chamber of Commerce last week, in a speech by their leader, Mr. Donahue, said that the Chamber will be actively promulgating and lobbying for financial regulatory reform. It's right at the top of the list. Many attempts have been made on 113th Congress. It doesn't look like it's going to happen. There's no time, but many bills were submitted. I have listed some of them that were passed. The Shelby bill, and as I go back to that bill for a minute that you mentioned, Jenna, which I think is an extremely interesting bill, it is a Senate 450, the Financial Regulatory Responsibility Act, introduced by him. It would basically do what some of the others do, rigorous cost-benefit analysis on regulations by the SEC, CFTC. But the interesting thing here is this Council of Chief Economists that the bill would create. Most agencies now, the SEC certainly does, has a chief economist who's supposed to look at a bill from that viewpoint. For most of its existence, the SEC was a lawyer-driven agency. and the lawyers are not economists. Generally speaking, it's usually mutually exclusive to some extent. So, but now, I think there's 50 economists working for the Commission. There's a lot of them, because you want the analysis of an economist on the cost-benefit analysis of a proposed regulation. So what Shelby does is go a little further with his council of chief economists from all the agencies to bolster the quality of economic analysis being conducted and ensure that the financial regulators work together to understand the aggregate effects that financial regulations are having on the economy. Aggregate effects, meaning that if you have a council of economists, you can look at the entire picture of what all of the regulations together that are coming out are having an effect, whereas before, if the SEC does a cost-benefit analysis using, and they do use economists now, it's only going to be the impact from that agency. But the Shelby bills let's look at all of the impact aggregately on the economy. So that's very innovative provision. And I think I expect maybe that's going to be coming out. It was his bill, but there are other bills. The Regulatory Accountability Act, H.R. 2122, which was Congressman Goodlatt's act. Mr. Goodlatt is chairman of the Judiciary Committee in the House. This bill was moving, and it passed the House in an omnibus H.R. 4, but again, this would provide the cost-benefit analysis. Also, interestingly, agencies would have to examine every alternative to the regulation to see if there's any alternative, or certainly the less burdensome alternative, that they have to select the less burdensome alternative. And I can't have time to go through all of these, but H.R. 2542, which also passed, was another regulatory reform act. All of these are in the same vein, but they have slight differences. Some would require agencies to retrospectively look at regulations, and some would even have it on a timetable, like every 5 years you have to look at a regulation again and see if it's doing the job it was supposed to do, or if it's burdening the corporate world or the economy too much. So there's a lot going on in regulatory reform, and this is going to be very big in the 114th Congress. And finally on that, just briefly mention the President, because the President in principle and agrees with certainly performing the process. I say that because of two executive orders that the President put out during the 113th Congress, and they were basically mandating cost-benefit analysis in one for non-independent executive agencies and urging it with others. And I just want to briefly give you the sites: Executive Order number 13563, Executive Order number 13579. I commend those to you, as the President's position on reform of the regulatory process is pretty strong, actually. It directs a flexible approach and a cost-benefit analysis, so we'll see what can happen. But it's not that people are that far apart on this, so right. I expect something will happen. Yeah.
And Jim, thank you very much. And Jim, I wanted to ask, I know there was one question that came in via email for you, so I wanted to ask this while I got a chance.
Yes,
so
please.
The question is about the CFPB, Consumer Financial Protection Bureau, and the question is, what power or authority has the CFPB executed that Shelby would like curbed? So I wanted to ask that while we're on the Shelby topic.
Shelby and others, I mean Henschling too, but and many others. The CFPB, a very unique agency created by Dodd-Frank, Consumer Financial Protection Bureau. Two things on it. One, it has a director. It's not a commission form. And secondly, it gets its funding from the Fed, not through Congress. So those are the two things that people are a little bit upset about, certainly Republicans and others. I would expect to see, there are a number of bills, we can't go through them, that never made it, that would have reformed the CFPB. One would be change it from a director to a commission form of governance, like the SEC. That's one thing that they're going to try. to do. And secondly would be the funding. Now, I think the funding would be a non-starter with the White House to change the funding and bring it under the congressional appropriations process. But I think, you know, one thing that could be done, and people have been mentioning this, is you could mandate an inspector general for the Bureau. That would probably fly. So I would expect to see that might be in a piece of legislation. It's almost certain there'll be a piece of reform legislation for the CFPB. You might be able to get a commission form of governance. You might get an inspector general. The funding is very problematic to change the funding right now. So.
Thank you.
Yes.
So before we wrap up, thank you so much for that, Jim. Before we wrap up, John, did we get any chat questions or questions via chat?
No, I don't have anything. Thank you.
Okay. All right. So thank you so much. If there are any other questions, you can also email me, and we can get those questions to Jim as well. And so I wanted to thank everyone so much for attending. You will receive the slides that we showed today, as well as that great list that Jim talked about kind of at the beginning and then during the presentation. So we'll get that out to you. And then we also do send out a really, really brief survey. It's literally 4 or 5 questions. So if you could just take a little bit of time and give us your feedback, that is how we prepare new weight topics. What are the experts saying topics for you? So we'd really appreciate it. And then, Jim, thank you again so much.
Thank you, and thanks for everyone for attending. Thank you.
Yes. Thanks, everyone. Have a good day.